All right, welcome to Chapter 8, Cash Fraud and Internal Controls. Our focus in this chapter is going to be on bank reconciliations, but I'm really glad that we have this kind of hodgepodge of stuff in this chapter to go over. We're not going to be dealing with a whole lot of journal entries in this chapter, if any. We do have some concepts in this chapter I'm not going to cover, so I'm going to just kind of scoot on by like petty cash funds and things like that. But I will be spending a little bit of time talking about fraud and internal control as well, mainly because I did spend a lot of time working on those types of those things. So with that, let's go ahead and move on with our chapter. There's your learning objectives. Okay. All right. So why do we even have? What's the point of internal controls? What is it, and what's the point of it? So internal controls is established so that we can make sure that all of our information, all of our assets, and everything about the company is protected, and the information we present is reliable. Okay, we got to have the ability to make sure the information we pass on to the creditors, the bankers, the investors, things like that, are going to be accurate. Because if we display anything that is not accurate, we could get in trouble for it. Okay, especially if it's something material and someone makes a decision based on that and it's wrong, then there's a problem there. Internal controls also help us uphold the company policies and to ensure that our operations are as efficient as possible. So what, Sarbanes-Oxley Act. This was a huge thing. I remember pre-Sarbanes-Oxley Act, I was in college at the time learning about accounting. When Sarbanes-Oxley Act came out, it was like the big thing. Everybody was all, "What's up? Oh my gosh, Sarbanes-Oxley Act sucks." You know, everybody. It was like you were cool. You were a cool accountant if you would talk about Sarbanes-Oxley Act. Boy, was that anyway. I digress. Now you guys like hardly ever like even know about it until you take this class. So anyway, um, what the Sarbanes-Oxley Act did was correct a lot of issues that the accounting world had. Accounting didn't have a whole lot of established safeguards to make sure that auditors' work was done appropriately and correctly. As a result, we had several companies have major issues because their accountants were auditing their own work. As a result, we had a huge financial crisis in 2005, and the Sarbanes-Oxley Act was created sometime in that same time frame. I believe it was 2005 that it hit. But anyway, um, what we had to do is that the managers and auditors had to certify that their internal controls were effective. The company had to state that their internal controls were effective. The auditors had to test to make sure that they were effective. Anyone that would violate that would be getting 20 up to 25 years in prison and fines. Um, and then the Sarbanes-Oxley Act created the Public Company Accounting Oversight Board to oversee the auditor's work, and that was a big issue with that because, like I said before, the auditor's work weren't being issued, and there was a former Big Five firm, which when they went away, it became the Big Four firm that it was Arthur Andersen, and they were auditing their own work, and they were telling the company to do something that was not right, and as a result, it caused Enron and WorldCom and a bunch of other companies, Staples, I think, included actually, to have a lot of issues. In fact, some of them went away. Um, we're just gonna, principles. Okay, so here's some principles of internal controls. Why do we have them, and what should they do? The internal controls should make sure that responsibilities for each employee is established and they know what they're doing. Want to make sure that there isn't someone doing the same thing. I'm sorry, someone isn't doing something and another something that makes it to where they can hide a transaction or do something mischievous. That's separating duties, and that's number four too. Separate record keeping from custody of assets. We want to make sure that our records are adequately maintained so that when we go and present our financial data, that it is not going to mislead anybody. We want to make sure that our assets and insure our assets and bond the employees. We bond employees so that if they do something wrong, then we're protected. Um, Again, divide responsibility for related transactions. That's also separating duties. apply technological controls, and also something here that's not here is to apply physical controls too. It is amazing what a camera installed over a place where money is cash is transactions and passed on. It's amazing what that would do. With the camera recording that and showing everybody what's going on, and being able to go back and identify who, where the money went. That's a huge control. It's a physical control, and would definitely help. Fences, walls around, like if you're a company like I did, I audited some school districts. They have a bunch of buses. I mean, if they just have these buses just out and about, I mean, someone could go in and vandalize them at worst, steal them at, you know, or steal them. I was gonna say steal them at best, but I'm like, that's still not good. But putting a wall or a fence around it prevents that from happening, or at least makes it harder for them to do it if they're going to try and do it. So here are each of the internal controls that we're going to go over. Established responsibilities. Just make sure that everybody knows who's doing what, and when money, especially when cash is passed on, it's counted and signed for by both the people, the person giving the cash and the person receiving the cash. That way, if anything goes missing, we know exactly where it went missing and who we should go to find out what happened. And a lot of this is, so we can determine fault. That has kind of a negative connotation to it, but ultimately that is what we're doing. We're trying to find out who it is. If something were to go missing, who was it that did it? We want to know who did it. And maintain adequate records. We want to just make sure that our records and everything is accurate. The biggest one is to use pre-numbered everything. If you do checks, pre-number them. If you're doing invoices, pre-number them. Everything needs to be pre-numbered. Receipts. There was this whole check scheme, or this whole scheme, I mean, that this person was stealing money from this entity, and they would issue receipts. They were pre-numbered, and they would take them and they would get rid of the receipt out of the book. But what they didn't do is take the receipt out of the deposit. I may have reversed those. I don't remember one. Either way, because they were pre-numbered receipts, as auditors and as fraud investigators is what we were doing. We were able to go and identify, yeah, okay, so they took this money, this money, this money because of those pre-numbered receipts. If they weren't pre-numbered, we wouldn't know. We couldn't do it. So pre-number everything that you can. Bonding in insuring your stuff. Basically, that if an employee does something mischievous, that it's in your insurance policy again. Your and insure your assets. I mean, if you have a bunch of vehicles, you're already better be insured, but you got to make sure too if they're vandalized or something else that you can insure them too. Otherwise, it's not always stealing, but it can be vandalizing as well. Separate record keeping from custody of assets. This is the reason why we do this. If I have custody of the assets and I'm recording all of what the assets are doing, well, this asset might go to my house and all of a sudden, whoop, that record's gone from that and we don't have it. I don't know what you're talking about. You don't want that to happen. So someone else is maintaining the records. I'm maintaining custody and control of the assets. And every now and again, someone that's not related to their department or my department is going to take the records from the company, or at least a list of the assets, come to my department and make sure that my assets are all still there. Okay, that's what that's all about. And that also kind of dives into this divide responsibility for related transactions. You should never have somebody doing more than they should. I should not be able to control the entire accounting cycle, which is recognize a transaction needs to be made, record the transaction, create the financial statements, and then reconcile those transactions. I shouldn't be able to do all those, because if I can take a lot of money from anybody, and we don't want that. Okay, and conversely, though, think of it this way: you're an honest individual. You have control over all of this, and you're not going to take something, but for some reason, something happens where something got diverted to someone else and they took it. Who are they going to come and blame? Because you have control over the entire accounting cycle, they're going to think you did it. You don't want that control over the entire accounting cycle, because then you're going to be blamed for it. So if you're in a situation, I've had students tell me this in the past, yeah, I have control over all that. I'm like, I know you're probably not going to steal anything, However, also as a fraud investigator, I've seen some grandmas go to prison because people thought they weren't going to steal anything. But even if they weren't, they're going to get the blame because they had control over all of it. So you got to make sure that you are not being able to do everything. This lady that stole $1.8 million, she had control over everything. She could get the checks. She had access to the check stock. She could write checks. She had access to the signature stamps of the people that needed to sign it, so she could stamp those. She would take the checks, deposit them into her bank account or someone that she had control over their bank account, and then she would reconcile everything. That's why she stole $1.8 million because she could nobody caught her ever until there was a new fire chief that came in. When that fire chief wanted to do an audit, she freaked out, said, no way, no way, no way. And it wasn't until somebody was a whistleblower and said, hey, this person's doing this, that they finally found it. So, anyway, separation of duties can make sure nobody can do more than they should. Technological controls. You can have technological controls, and this is good. But if you depend on these, you're gonna get ripped off. Someone's gonna find a way to get around these. Um, Cash registers make an electronic record of each sale. Yeah, that's excellent, but there's still a way to edit those. So don't rely on that. Okay, make sure that even the reconciling or the electronic records that you have a way to tell if someone tampered with it, if somebody messed with it. Have a audit log also. Time clock records records exact time employees work. All right, that's fine. Again, you could probably break into that system too and find a way to edit that. ID scanners limit authorized access. Yeah, if you have a little scanner, but hey, somebody can lose their ID, get it taken, something happens. It's possible. That's what I'm saying. You need to have these technological controls, but you also need other safeguards, and you can't rely solely on technological controls. They won't be enough. Regular and independent reviews, of course. Have audits come in. Even if you're not required to have an audit, unless you're like just whatever, have agreed upon procedures come. Auditors come in and do agreed upon procedures. It's cheaper, it's more direct, and just make sure that things are going well. If you're a huge company, you're going to have an audit, especially if you're traded on the SEC. Excuse me, the stock exchanges. The SEC requires you to have an audit done annually for those. So anyway, here's your kind of internal control situation there. All right, blockchain is a control. So it's just a basic way of having more security. Make things that you can't hide transaction stuff. That was another thing this lady did. She deleted transactions, but because I was able to go in and look at the audit log, I found her deleting transactions all over the place. So we were able to nail her with computer tampering too. It's kind of fun. So here's your limitation to internal control. First of all, human error. Okay, people are going to make mistakes. They're going to enter things that are wrong. It's just going to be a bad situation in that regard. But you also have human fraud. I can intentionally put something in the system that's wrong, or fail to put something into the system so that I can steal it. Okay, those types of things happen. There's something called the fraud triangle. There's three. It's a triangle because each corner or each side represents something that is usually present for fraud to occur. And the triangle represents opportunity, pressure, and rationalization. Now, for most part, in my experience, everybody had rationalization. Everybody has to have opportunity, but I didn't have anyone really doing pressure. There was one lady who just stole because she just stole the $1.8 million. There was no financial pressure. She wasn't in debt. She was a spendaholic, okay? But I didn't see anything that indicated that she lacked money. So I didn't see the pressure. I think she just was a klepto. She could just do it. And so there wasn't a whole lot of pressure there, but she certainly rationalized it, and she certainly had the opportunity. No matter what, you have to have the opportunity, because if you don't have the opportunity, you can't do it. So, for example, I used to work in accounts. Oh no, I guess I did have opportunity there, but I never did it. Um, I work right now for a company, and I do their books. Okay, it's a side gig I do to help with some things. Um, I don't have any access. I have no opportunity. I have no access to their finances. I have no access to their checks. I have nothing. And I told them straight up, I said, I don't want anything like that. I'm not writing any checks. I'm not doing anything. I'm recording. I'm keeping your books, and that's it. If you have a transaction, I'm recording it. We're done. I have no access. I have no opportunity. So even if I have pressure or rationalization, I can't do it. So that's what I'm trying to say is that you have to have opportunity no matter what. If you don't, you don't have a fraud. Pressure and rationalization. Rationalization usually comes in the form of, I just worked so hard and I deserve this money. They don't pay me enough. I had a fraud investigation I did on a guy who was cooking. He was a chef, actually. Went to Hyde Park, New York, the prestige place to get your education for culinary arts. Working at a smaller establishment, but he was also taking students from the high school and catering to places as part of a club at the high school. And the high school was paying him, albeit very little, but still paying him for his services. And what he would do then, he would go to these places and he would give them two invoices, one for the food that would give the money back to the school, and another one was the for his work. He would get an additional amount of money for um, for his labor, he would say. Well, he's already getting paid for his labor, and the agreement between him and the school was that he would be doing this and that his work was so he was basically defrauding the organization. So had to go to, I don't think he went to prison because that was his first offense or jail. He definitely had some community service to do. So a lot of that, restitution, things like that. So and again, your internal control is the cost benefit constraint. If you're going to put in something that is only going to make sure that your petty cash fund is not going to get ripped off, and the only money you have limited in your petty cash fund is $100, it's probably not that big of a deal. Okay, you don't need to put a petty cash huge cost thing on your petty cash fund. Okay, something that's a control that's going to cost you a lot of money to do that. If it's only $100. But if it was like $20,000 in your petty cash fund, because you guys are, your company's just awesome like that, and you do a lot of stuff out of your petty cash, you might want to consider something like that. That's what we're looking at with cost benefit. All right, here we go. Cash and cash equivalents. This is where I'm going to kind of breeze by. Here, cash. Oh, cash control over cash is very important. You got to have it. All right. Best way to do it is don't deal in cash. Deal with checks. Use check cards. Things like that. That way you have a transaction. Okay, cash is hard to find. Cash is hard to track. Okay, so you want to make sure you're doing something that you're going to be able to monitor that. Now, that doesn't mean that people aren't going to pay in cash, but if people are you receiving money payments from customers, two people are there. Okay, make sure they're watching, and you have a video camera, in that situation. That'll prevent that from happening. Separation of duties and things like that. Okay, make sure people are paying electronically. It's just safer. Not to say that they still couldn't steal it. But anyway, cash, anything, currency, coins, deposits in your bank account, things like checks, cashier's checks that you've received, not your checks that you've written, just things that you've received that are guaranteed cash. That's considered cash. Cash equivalents is anything that can be quickly turned into cash. All right, something really quick. Very short-term convertible maturity date, a CD, money market accounts, those types of things are going to be your cash equivalents. Okay. And cash management, again, we want to look and make sure that we're keeping our cash safe and that we have a minimum amount of cash just enough to operate on hand. We don't want too much of it because then it'll put us in risk. Okay. Internal controls over cash receipts here. Again, like I've already been saying, make sure two people are counting the cash. Make sure two people are watching the cash. Make sure that cameras are up and everywhere. Make sure people are signing for the cash. When someone does a count, they sign it. Someone else counts it. They sign it. Just, those types of things. Cash over and shortages, don't worry about that. Cash receipts by mail, again, controls. We've kind of beat that discussion. Vouchers, make sure all vouchers are pre-numbered, things like that. Petty cash. You might have some things you need to use from it. Just you can, just it should come out of normal journal entries. All right, let's talk. Here we go. Let's talk about basic bank services. Now, using a bank is very frequent and common. These are some of the things that a bank can do for you. They can do other things as well. They can create cashier's checks, money orders, all kinds of things like that for you if you need them. You can get a checking account, get your bank accounts, obviously. Excuse me. Most companies are not going to have a savings account. They're only going to have a checking account. Can't think of why a company would need a savings account. They would normally, if they had money that they needed to put into some savings account, they would put it into something they could get a return on it. I don't know if you guys know what signature cards are, but basically a signature card is that if I am a person on a account, I will sign a card, and everybody that will sign it are authorized signers on that account. So when it gives them the ability to go sign a check. And the bank is supposed to compare those signatures to that check every time, but they don't. So it's kind of maybe an outdated thing. I don't know, but they still do it and they're supposed to do it. Deposit tickets, if you guys have never had a bank account, this is kind of what one might look like. You basically tell them how much currency, coin, and um, if there's any checks, you're going to list the total amounts and then your total deposit. Sometimes you'll withdraw some of the cash out of that and then you'll have a net deposit. I worked for a nonprofit where we did the cash handling, okay? And we had, we didn't have a camera, which I wished we did, but we would have two people count it. And there was one time where money went missing. It was all of the cash, and we're like, and it wasn't us, thankfully. We went through and did all of the work and then passed it on to the higher ups in the nonprofit organization for them to continue. And then I never heard of anything since then. So uh, the error had to have come from the teller. And I don't know if the teller misplaced that money or if they stole it or counted it to someone else's stuff. But either way, we were cleared because we both counted it, we both signed for it, we both put it in there, and we both went to the bank. And I watched the person put it into the deposit at the bank. We were both cleared because we both could vouch for each other and say, yes, we both counted it, we both know that it was there, and we turned it into the bank. It's a comforting feeling to know that when something like that happens, that you are covered. Okay, so anyway, but then you have your deposit slip, and if you take it to the bank during normal business hours, they'll count it in front of you again, and they'll sign things and give you a proof of that deposit, which is a nice thing to have. I have had a student one time tell me they had no idea what a check was. And so I guess I got to do this because we are kind of dealing with the checkless environment, even though I have checks in my drawer right here. But this is what a check might look like, especially from a company. Um, you got the check, the negotiated part up here. You're gonna have a perforation right here, and then you're gonna have what it's for, and that's kind of what you get to keep for your records. You have the dollar amount written numerically. You have the dollar amount written um, alpha numerically, I guess. You write it out. Why do you do this? Because I can easily add a one right there if it was just numeric. And all of a sudden, instead of $375, it's $1,375. So if I write it out there, uh, right here, and I try and put one over here, it looks suspicious because nobody starts there on a check. I always start right there on the check as well. It also makes it hard if it's a printed check. See, that's another one. Don't do handwritten checks. Do pre-printed ones. Print them out of your printer so that this part here is typed out. They can't type again on it. It'll look too funky. It'll look stupid. So anyway, memos telling you what it's for. This is the company that wrote the check. This is the date of the check. Most checks are not supposed to be negotiated after 90 days. Although again, I will tell you, the banks don't look at that. This is the signature for the person who wrote the check, or at least an authorized signer. Um, this little lock sign means this check has security features to show whether or not it's been duplicated. So, and then this other stuff, honestly, it's probably, this is the check number, but this little 99-DT//101, it's not a website. I honestly, I see it on them checks. In fact, I'm going to look at my checks and see if it's there too. Um, yeah, I have mine in the upper part of it. I honestly have no idea why that's there. It's not anything I've ever dealt with. Know why it's there, but just know that it means something to somebody, just not to anybody that deals with checks. Here's what a bank statement might look like. You got all this information here. You have a description of a transaction, whether it was a withdrawal or deposit or bounce. If you bank with Chase, I hate the way they do it. They break everything up into groups for you because they're like, we're going to help you think. And so it drives me nuts because I like to see a running balance and I can't see it in the way they do their bank statements. And I hate it. I hate it. I hate it. But anyway, here's your bank balance at the end of the month. They show you your balance at the beginning of the month, everything that transpired for the yawn. What do you notice about this? You have check 123, 125, and 127. Where's check 124 and 126? Well, we'll get to that. They're called checks, outstanding checks that haven't been cleared yet. So what do we do with a bank reconciliation? That's the main thing you're going to learn from this chapter and what you're going to need to do and perform. So bank reconciliation, you have your book balance and what you're doing in your books, and then you make your deposits and you're dealing with the bank. Banks can give you a bank statement. Your bank statement, your book balance are rarely ever going to equal. They're going to be different. Why? Because the bank has done some things to your account that you don't know about, like fees, or maybe they've collected money on your behalf or deposited interest on your account. You don't have those recorded on your book balance, so you need to do that. Conversely, your book balance is going to have things that are recorded that your bank statement hasn't accounted for yet, such as you wrote a check, gave it to your Joe Schmo, and Joe Schmo hasn't gotten around to electronically deposit. I mean, there's no reason why a check should be outstanding longer than a few days anymore because people have this way of just snap. It used to be you had to drive to the bank and it's just, a day trip almost. Not really, but, I'm from Flagstaff, so it was kind of a day trip. But you had to make a special trip to the bank and you may not get there again for another week or so. I mean, or if you got a check and your parents had to do it for you, I mean, good heavens, you waited a while for that check to get cashed. But nowadays you just snap a picture of it and it goes in there. It shouldn't be outstanding for very long, but there's some people that do that. So you're going to have this check that's outstanding and you're not going to be able to negotiate that. And it's not hit the balance on your bank. So you got to subtract those out. You've added deposits. Let's say on the last day of the month at midnight, you make the deposit because you were up and trying to get it done before the next day, and you go put it in there. Well, it's recorded on your books at the last day of the month where it should be because we record our revenues and everything on the counting period that they were in, but the bank's not going to record it until the next month. So your bank statement you get is going to show that they haven't received it yet, even though they have. So you're going to have what's called a deposit in transit. You're going to have to add that deposit to the bank statement showing that yes, they did get it, even though it's not recorded yet on that bank statement. So there's going to be some adjustments. Plus, there's going to be corrections that are going to be made. The banks make errors. Okay, not used to. I have in my lifetime found one time that the bank did one error. Okay, that's it. And I've been doing this since I was 19 years old. Okay, and I was very meticulous in checking everything. And I found one time the bank did an error. Okay, it's not very often, but they do make errors. Okay, and that doesn't mean that one where they like the money went missing. That was fraud. This was just legitimately an error, and they had to adjust their side. And I was able to talk to them and convince them, and they did, and it was great. But most of the time, the error is going to occur on the book side. You wrote a check accurately and sent it out and then negotiated through the bank correctly, but you wrote it wrong in the books, something like that. Okay. It happens. It's no big deal. You just fix that. Right. So here's what we're going to do. And the book in this slideshow is going to show you one way to do it. But when I do the homework example, I'm going to show you a different way to do it. It makes more sense to me doing it my way than doing it the book way. The book way here says, start with your bank balance and do everything that's going to adjust your bank balance, and then go over to your book balance and do everything that adjusts your book balance. I don't think I like that at all. What I like to do is I like to start off with both your bank and your book balance and do each transaction as they come and adjust each one as needed. That way you make sure you do every one of your transactions. If you're good about putting your little check mark next to it and saying, yep, I've done it, then either way is going to be fine. And it's not going to be a problem. But either way, when we adjust our bank balance, we are going to add any deposits in transit. We're going to subtract out any outstanding checks, and we're either going to add or subtract any bank errors to that bank statement. And that's going to give us our adjusted cash balance. Then we're going to start off with our book balance. We're going to add any collections and interest that we got from the bank. Banks can collect money on our behalf, and that's possible. We're going to subtract out any bank fees, and we're also going to subtract out any NSF checks. That's non-sufficient funds checks. And what that means is that somebody gave you a check, you recorded it as a deposit and submitted it to the bank. But when the bank got it, they ran it and said, whoops, they didn't have enough money in their bank account. Here's your check back. Go talk to them. So basically on your books, you're showing that that money is deposited into your books. But the bank said we're not depositing that because there's not enough in there. So we got to subtract that out of our book balance. And then we got to go find them, charge them, the company or the customer a fee, tell them they owe us not only the amount, but also the fee for the non-sufficient funds check, probably tack on a little bit of a, our hassle as well, and get that corrected. And then we're going to add or subtract any book errors we may have made to get our adjusted balance. The adjusted cash balance on both the reconciliations should be equal. If they're not, you did something wrong. Here's an example of one. Again, they're starting off on just the bank statement. They have the bank statement balance, then they add in the deposit and transit, then they deduct the outstanding 2 checks that I identified, and then you have your adjusted bank balance. Then they go over to the book balance, they add the collected note on the behalf of the company, add in the interest the bank gave them on their bank account, $8 on, let's just take that as 2,000. Sorry, I just curious, I didn't ever try this. Let's just take an average of 2,000. Our math, let's see, algebra, it's going to be 2,000 times x equals $8. What was it? What was our interest? $8. So let's just say it was $2,000 times x. So we're going to take 8 divided by 2,000. So we got $8 of interest. We're just saying it was an average daily balance of around $2,000. This bank gave this company a whopping 0.4%, not 4%, 0.4% of interest on their bank account. That's why I hate banks. They charge outstanding interest, and we freaking anyway. Subtract that interest, or add in interest that we got the whole 0.004%, or no, 0.4% of interest. We're going to deduct out the check printing charge. So we had the bank print us some checks. They charge us $23. We also had a check that was non-sufficient funds, $30. We subtracted it out. There'd also be a bank fee in there too. They should have included, because if you have an NSF check, the bank usually dings you for that. And they ding you if you try and deposit one too. Some do. So entries from a bank reconciliation, these are the ones that require an adjustment. Anything that they collected on our behalf, interest that we've earned, expenses, and NSF checks. Those are the ones that we need to do that's based on the bank reconciliation on the bank balance side that we didn't record that we need to put into our books. And those are the journal entries for it. And then we're getting close to the end here. Here's the days sales uncollected ratio and use of liquidity assets. Basically, you want the days sales to be lower than higher. It looks like Jack in the Box is doing better than Starbucks is as far as a trend. It looks like kind of Starbucks is all over the place. But the bottom line is how long is it taking you to receive your money? How many days does it take? Starbucks is doing better overall because they have the lower one. But Jack in the Box is doing something right. They're fixing something. Whereas Starbucks, maybe they are from 2 years ago, but something's clearly going weird. And maybe something happened in year one where, well, it would be kind of had a converse or a different Starbucks decreased whereas Jack in the Box increased. So I don't know. It couldn't be something in the economy. Something just weird happened there. But anyway. All right, we'll look at this. Documentation and verification. Yeah, these are just some things that you can have to help verify people are doing the right thing in your company. We have a thing in the fraud world called trust but verify. Listen, I wouldn't hire you if I didn't trust you to do the right thing, but I'm going to make sure you're doing the right thing by checking your work. Okay, I got to know that because I'm not going to just sit there and blind and let you steal from me blind. I'm not. You can't guilt me into that. And if that's Deal breaker for my employee. Okay, there's the door, because I'm going to make sure you're doing the right thing. Basically, it's showing you these different ways of doing checks to make sure your cash is protected. Um, the information across all documents are verified, meaning from the source document to the check to the reconciliation, everything's checked. Checklist of steps necessary for approving an invoice and payment. You want at least 2 people with eyes on that, preferably 3 would be great. Voucher is complete after the invoice has been checked and approved. Vouchers are for purchasing things, making sure everything's correct and everything. If you have some weird vendor you've never heard from, you might want to check and make sure they're a real vendor. Several fraud schemes that colleagues of mine have investigated were for vendors that didn't exist, and so they got stolen from because of that. They thought they were getting something when they weren't getting anything. So that's chapter 8 for you guys. Your word for chapter 8 is meeting. 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 M is in mother, E is in echo, E is in echo, T is in tango, I is in India, N is in November, G is in golf. Meeting. You guys keep working hard, okay? We're getting close to the end of the semester here. If we're in chapter 8, we only have 2 more chapters after this to work on. So please make sure you get that taken care of. If you have any questions, I'm here for you. Let me know what I can do for you. Please let me help you. Let's finish this semester strong. All right, you guys have a good one. We'll see you in the videos.